Deflation or hyperinflation? No. And I apologize. This is a second recording, so it's a learning curve to find out how to do this correctly. Anyways, the reference for a lot what I'm going to speak about come from mainly these books because they have hundreds of years of history. The Next Economic Disaster and a Brief History of Doom, a couple hundred years there. Ray Dalio's Big Debt Crisis, of course, goes back in history. Manias, panics, and crashes. All of the epic bubbles throughout history. The formulas, what causes them, how they end, the procedure, or let's say the bullet points, how they unwind. This time is different. 8 Centuries and The Edge of Chaos. Probably a lot of people don't know about this book, but it's an excellent book also. So the question is, will we get deflation or hyperinflation? And this is an ongoing debate amongst those who studied history. And I've looked at both sides, and I'm definitively in the debt deflation. Well, let me explain why. The first thing we should be aware of is that we don't have a pure fiat economy. We don't even have a capitalist economy. Appropriate name, which Richard Duncan gave the name, he's got 3 excellent books, by the way, is creditism. We went from capitalism, savings, and investment into productive industries to creditism, whereas there's no restrictions within the fiat monetary system, and we need ever increasing exponential growth of debt and spending to sustain the model, which is now coming to an end. So we have to look at the precursors, and this is not Argentina, because the most important aspect of hyperinflation is its sister, right? If we look at the brother of hyperinflation is extremely high, rapid inflation rates. What goes along with it? Dramatically higher interest rates. And since we have a levered credit bubble, primarily in this real estate, predicated not on incomes or the inflation rate, but predicated on record low interest rates, or let's say we did have record low, 5,000-year lows to be exact, which society levered from, we're vulnerable to any rise in interest rates. Now, this is an important factor because interest rates are in a secular rise, and they're surprising everybody why they continue to rise. That's another story. That's another presentation. So we have a global, now mostly I'm focusing, of course, on Canada because that's where I live, but the same argument can be made in the UK, United States, Australia, New Zealand. We have vast credit bubbles that were inflated because of giveaway interest rates, and they've risen because of credit inflation. Now, when that starts to reverse, and in the case of Let's look at Canada. We see the real estate prices, and this is during the monetary wave. And for new students, the monetary wave within the economic long wave is the falling price of credit, which enables society to leverage and take on more debt because most people look at their cash flow, not how much debt they're carrying. And at the peak, 21% in interest rates, there's almost only so much mortgage debt that you can carry. And when they gave it away in 2021 at 0, you could lever so much more. And since now that is ended, as we call it, the monetary wave that causes Ponzi finance, it goes into reverse. Does that make sense? Now, we need to have the precursors, and if you could look at here in Canada, and this is from Richard Vague's books, it's just historical, and it's just a comparison. And I'd like to use the analogy of Peter Kundal, one of my mentors and a great value investor with phenomenal track record. And he said, bubbles could always go larger, and valuations are only a measurement of risk, not its timing. So let's say the same thing about private credit. It's gone on beyond the 150% level that would allude to a dangerous area. And you can see, comparatively, we surpassed Japan in the early 90s and the U.S. in 29. And we know from that time frame they had great credit contractions, banking crisis, and deleveraging by the public, right? Because it was unproductive debt. There's only one type of productive debt, and that is what corporations or industries use to expand manufacturing because of new demand or technological revolution, right? That's what creates productivity and true wealth. So here is the same data, and I'm just looking at the point where Richard Vague, draws a line in the sand, so to speak. And you can see we had a early deleveraging in Canada where interest rates did spike. So we did deleverage, and then that deleveraging caused the tripling of real estate prices from about 83, 84 to 89, which yours personally was caught into. And then you can see right up until 1992, private debt to GDP just went sideways and real estate prices were rising. But something happened after 2001, and then we saw it just skyrocket after 2007. So we just saw this explosion in private debt, and that primarily went into real estate. And like you see, I drew a trend line from 2007 up until recently, and it's broken that trend. So we're obviously, now a lot of that has to do with GDP collapsed in the year 2020, 2021, and it's reversed. But still, we're at the levels where there is a lot of danger. Now, if you look at household credit growth, we can see it's in a secular slowing. From the bottom in 1946, it peaked in the 70s, and notice the lower highs. Even in spite of money being given away in 2021, year-over-year change only grew at 7.7% versus 2007, 13%, 1987, 17%. And look at the 1970s. That was an environment rise in interest rates. No bubble, no collapse. Record high interest rates, and the reason was real incomes were rising, right? So no bubble was going to burst because prices kept within the realm of 2 to 3 times income, right? And income started to stagnate. So this is clearly, we have a massive asset bubble, and I've shown this chart before. The same thing with mortgage credit growth. Look, it peaked in the 70s, and we have the secular slowing pointing to a deleveraging at the latest by the 2030s. Now, if you look at debt deflation, it's once these assets start to collapse, it starts to impact the banking system because the debtors, as we are seeing now, are unable to keep up with their loan obligations. And then the banks are forced to take back the collateral as security for their loans, but then they're significantly less. Now they're trying to delay that and expand that. Then the banks have huge capital losses. The capital losses impacts the bank's ability to extend credit. Now you can't have a credit bubble if you can't extend the credit. And then that lack of cheap credit causes a debt deflationary cycle. On the other side, the consumers see asset prices are falling, so they become fearful. This is the normal reaction. And I know from experience in the early 90s exactly how the reversal psychology occurs. And so they step up and they don't purchase unless they can find a bargain. So that's why real estate activity collapses. And then because there's so much speculation moving up into the bubble, a huge amount of supply hits the market, which just further drives down prices. And then it just becomes a cycle, debt deflationary cycle. And Irving Fisher alluded to this, to the downside until equilibrium occurs where prices are reasonable again. And then the cycle will start again. There is nothing new. And that's why I'm in the deflationary camp. Now, here is an important point. 97% of the credit in the world is created through the banks, through a loan, and a large part of that is real estate. Once asset prices start to fall, the banks become fearful because of losses and the insolvency or potential insolvency of the bank itself. Then the consumer, as I alluded to before, becomes conservative. It feeds on itself. Now, governments, and there's a thesis that the governments are going to print, and, but that money only goes onto the balance sheets of the banks. And if the banks don't lend, then there will be no growth. Now, you can have hyperinflation after the fact, after a debt deflationary collapse, once the credit is all destroyed, of course. So I'm not saying it cannot happen, but this is why I'm in the deflationary camp, because the central banks don't create most of the credit, the banks do. You have to understand that distinction. If you understand that distinction, you can see why so many people are forecasting a different outlook, right? And let's be respectful of it. We'll follow the indicators, and if they change, and if it does become hyperinflation, we'll see it. Highly unlikely unless they're able to inject credit. But again, it has to be the consumer wants to expand their use of credit. Remember, during economic winter, or if you're not aware, during economic winter, the psychology of the masses becomes fiscally conservative. Governments will be forced to be fiscally conservative, live within their means. Corporations will. The average Canadian, American, European will be fiscally conservative because the economy is shrinking. And that's why I've said, if you haven't started to deleverage, now would be a good time before the economy forces you to. Okay. About the website, as I said, I've uploaded, and the website is here to serve four purposes, really. I wanted to, when I became aware, the long wave is for me, is like discovering the secrets of the past and how the world works. And there's very few of us who have access to it. You do now, and it's a long story of how that occurred, because this Keynesian philosophy took over mainstream economics, and this is why they're going to fail. They don't have a grasp of how the economy works, right? Because I'm not a traditional economist. I taught myself economics because I was curious how things work. I was devastated with losses, and I was a financial advisor. So, you had to become at least aware of how things work. But anyways, we're approaching economic winter. So what can you do, right? You can only protect yourself, your family. So the website is there to help people work through economic winter, because it's devastating to the economy. It's a massive creative destruction, industries, education, the political cycle, civil unrest, massive changes are occurring. And so is the markets, right? We see systemic collapses in real estate and the stock markets. And that's going to impact your portfolio. So you can understand one of the reasons why I left in 2012. Didn't want any part of that. I couldn't help the public or clients at the time. So one thing is a model to help you get through the process. The second thing, I'm starting first Saturday of every month next month, and that will be to help homeowners who've gone through devastation, not knowing what to do. I've been there. I went through the whole process, so I know exactly. I can give you information to work with your advisor, accountant, mortgage broker, real estate agent on what's coming and how to be prepared emotionally. I'm one of the few from the top. I bought in 89, February 89 to be exact, at the top, and I know how tough it's going to be. So I'm an expert in that, and I rarely say expert. The other thing is to work in helping business transition to the decentralized renaissance. Man, I know Klaus Schwab has this wet dream of more power to the UN. Well, that's not going to work out, obviously. Public won't accept it, so the conjunctive cycle is swinging toward decentralization, right? So how do we take advantage of those opportunities and the technologies that are coming? And then the fourth one, of course, is people are interested in the long wave, right? There's a lot of people like myself are curious how things work. So it's a preface for all those things. So please subscribe. Make sure if you're interested in the model, it's a consistent long wave model. I learned from Martin Pring, who has a very successful tactical allocation model in the United States. The results are fabulous. And it just keeps you out of bear markets by being cognizant of the aging business cycle and valuations, which are always important when you're allocating capital. And of course, the most important thing, questions. I know you have a lot, and I appreciate that. I read them all. I'm learning a lot. I have some really smart people. I have a couple that are asking me great questions. I love it because it makes me think, right? And I'm always questioning my own model. You have to. You can't say, I know everything, right? Only certain industries profess that they know everything. Well, that's a religion. It's not factual. So anyways, the long wave, the model, history, the credit cycle, the credit boom, the bust, the real estate bubble and its bust will cause a debt deflationary cycle more than likely in 2024. As you can see, if we continue without any kind of bust, it was going to happen by the 2030s because just the demand for credit isn't there. And immigration doesn't fix that, right? They don't have the incomes. They don't have the vast savings to even to put down as a deposit. All immigration is doing is causing inflation, which only causes interest, because they have this initial demand and that wasn't planned for. So that's inflationary, which causes interest rates to rise, which will cause a lot of strain to homeowners with higher interest rates who are resetting at levels they never thought would happen. Right? Does all that make sense? So for now, nothing has changed. Debt deflation is inevitable, more than likely in 2024. The models, and that is the models is the demographic model, peaks, the millennial buying power peaks next year, as it did with the baby boomers in 1989 to 91, right? It peaked or peaks over the 22 to 24 period. This is when I knew they were going to kick the can down the road, and the real estate cycle is the most leveraged market. So that's why the early 2020s was going to be the end of, or the peak of economic fall. And then we move into economic winter, right? So, people are interested, and they need to be aware of how to deal with economic winter, rights and education, information. There's a lot of upheaval, and I'm going to get into that more as we do these videos. I'm liking the response. I should have started with this a long time ago, because the comments are, Joseph, can you keep it simple? Because I'm not here to educate the educated about economics. I'm here to help Canadians transition through economic winter, what's coming. As I said, I wanted to create one of the top forecasting models in the world. Only because of my experience, I'm curious, and as a baby boomer, I have to be concerned because we're coming into a season that is devastating to asset values. So a combination of all those things. But, what really turns me on is, of course, building the decentralized renaissance for Canada. That's exciting. I mean, Condrate noticed these economic booms are fueled, or the upwave are fueled by technological revolutions, and that's coming. So it's not all bad news, right? Just getting through 2024 to 2040, give or take that time. I still should be young enough, kicking around to see that. I'm looking forward to economic spring, trying to survive like all of you through an economic winter, and we'll get through it, right? That's all we can do. Because society, for whatever reasons, have forgotten the lessons of the past. The leverage, the fiat monetary system, central banks abuse, governments abuse. I mean, the political cycle is driven by the short-term re-election cycle. They don't care about the amount of debt. We're going to hit a wall. That's going to cause a political revolution because there isn't enough productivity to pay for all this debt and all the promises by the government. So governments will shrink. So will the finance industry, because Canadians will be deleveraging and asset prices will collapse. I hope this helps. We'll keep it going. And thanks for watching.